the money supply is a very bad indicator for anything really, because the money supply could go up for reasons that are absolutely non-inflationary. If we want to talk some more about inflation and what MMT actually thinks
well, that's the big
inflation.
argument against it is no such thing as a free lunch. If you let the government create as much currency as they want without the constraints of taxation, you're going to end up with massive inflation. And given that that's the first objection, and I always know, like when you've got smart guys like yourself in a theory, then it's not like you haven't heard the what about inflation?
Right.
That's a good point. I never thought about that. It's like, how do you get roads, man? How do you get roads? If you don't have a government, who's going to fund gain of function research for coronaviruses? Come on, man, you got to have that stuff. Because if there's one thing the communists who study gain of function coronaviruses in order to help the human race, totally in alignment with communism, which always has as its number one objective the protection and enhancement of human life. Anyway. So this is the what about the roads question. So a lot of work has been done on, okay, so let's say we uncouple, in a sense, government spending from tax revenues. We get rid of the concept of a deficit as a bad thing. People think, of course, and then they hear AOC and Bernie Sanders, and, oh my God, the floodgates to the tsunami from hell of money printing is going to be opened. And this, of course, a lot of MMT people knowing that this is the first objection. I wonder if you can give the top couple of pushbacks on that.
What MMTers think creates inflation. So first of all, just looking at money supply is the money supply is a very bad indicator for anything really, because the money supply could go up for reasons that are absolutely non-inflationary. For example, quantitative easing is an example where people who hold bonds in their portfolios and their savings deposits sell those bonds, and the bonds are replaced by cash that the Fed has given them. And now what are they going to do with that cash? Right? It's sitting in a portfolio. It's a savings account. They're going to find probably the next best bond or whatever they can find to just recycle through. And so that kind of money supply increase is meaningless. It's a private sector asset swap. And very little has changed in terms of spending.
It doesn't end up at the mall for the most part, right? That kind of money doesn't end up at the mall. And this is the old 363 rule of banking. You probably heard of this before. 363 rule of banking. Here's how to be a banking genius. You borrow at 3%, you lend at 6%, and you go play golf at 3 o'clock in the afternoon. That's the 363 rule. And it is a form of welfare, of course. Create a bunch of money, drop it in a savings account, and then let banks borrow that at some sort of premium. And that's not the money leaking out into the economy as a whole. And again, correct me where I've gone astray, but that's what the Austrians, they look at this, oh my God, $1 trillion. It's like, yeah, but that doesn't end up at the mall. That gets bogged up in the interest rate payment siphon drip of the upper echelons of the financial system. Again, correct me if I've gone astray, but that's why you don't see this kind of inflation coming out of that kind of money creation.
Right, exactly. And
there was a lot of R's in that, right? So if you want to correct, right. So if you want to correct me on something, please go ahead.
I meant to just move on to some other points regarding this topic.
Okay,
but you're absolutely right what you said. MMT does acknowledge explicitly that deficit spending, too much money will start leading to inflation at one point. And too much money means if you print beyond the economy's capacity, which is one thing that I've pointed out on our other calls. If you look at the US economy's capacity utilization, it'll help you understand why we haven't seen this inflation that the Austrians keep talking about. Because even pre-COVID, US economy capacity utilization was only 80% or so. Of course, after COVID, it collapsed down to something like 60% or whatever. So then all this money that comes in, the capacity is there to produce things that are purchased, that money chases. So that's the reason why it doesn't have to, even bigger deficits don't have to create inflation. Now, if the deficits grow so large and we create more and more employment with full employment, at that point, we will start seeing some inflation because now the government is, or whatever money comes into the private sector, is chasing employed resources, or is trying to pull employed resources out of the current
It turns into an
employment.
auction, basically. You got to bid up the stuff that's already
Right
in use.
And so, but then at the same time, so MMT says this can start causing some inflation. So that's why MMT-minded investors have been saying now, okay, because of all this deficit spending that's been going on, and it will probably continue, we're probably going to see levels of inflation that we haven't seen in a long time. At the same time, that doesn't mean, we're going to see hyperinflation. It just means we're probably going to see inflation go above what we've grown used to over the past 20 years or so. It may go up to 4%, 5%, or something like that.
Well, I'm sorry, just because the government is printing money to pay people not to work. So they're putting money into the system while reducing labor, goods and services out of the system. That's going to lead to an inflation. But simply the money printing itself is not enough. And of course, the ideal, as far as I understand it, I mean, I don't know how could be achieved except in a pure free market. If the economy is growing at 4%, you kind of want the money supply to grow at 4%. I think the in-use money supply, not all this backed up dirigible stuff. But you want so that you keep dollar value to goods and services relatively constant, so you can make future calculations without having to guess what inflation is going to be in 10 years. And so, so I just really wanted to point that out, that MMT, as well as Austrian economics, but almost in a way, MMT would predict the inflation levels better, because the Austrians will mostly look at money creation, whereas the MMT will look at, in other words, how much water is going into the bath, but MMT will say, well, how close is the bath water to the top? Right. And that's the big difference.
For Austrians, it's very binary. It's always it's hyperinflation, or we have a gold standard and everything's perfect. And there's much more nuances if you observe the economy through the MMT lens. Now, I wanted to talk about other causes of inflations, because yes, I just acknowledged MMT does say deficits that are large, especially if the closer we get to capacity utilization, can cause some inflation. Also, if we're pre-capacity utilization, but all the money gets spent on bombs and wars, then that's also inflationary. Not just because you're not producing anything, but also because in the military, you have to hire very specialized people to build things. Engineers that have very rare skills and things like that. And those engineers get paid a lot of money, but in return, they don't produce any apples or oranges or whatever consumer goods we look at when we try to assess the inflation levels.
Well, the business is death, and the business is good, because it's worse. It's worse than neutral, because you're actually destroying resources. So you take a bunch of oil and you fuel a bunch of military planes that drop bombs somewhere, and then you need a whole bunch of oil to rebuild whatever. Like, it's a massive net negative on the economy as a whole. Although, of course, if you just look at the payroll, it looks like it's going up, but the long-term undertow and drag on the economy is almost beyond comprehension.
Right. So that's obvious. So you destroy, but also, so the other inflationary factor is just paying resources a lot of money that don't produce consumer goods, but they will end up purchasing consumer goods from the consumer sector. So one of those is obviously the government sector, because these things don't become available on the market. Another one of those sectors is the export sector. So if export surpluses grow as a percentage of GDP, that is inflationary, because people from abroad who are using the currency of a different currency issuer show up in our country and buy up goods, and there's more money in our system now, and it's fewer goods for the consumer. So that's another inflationary factor, potentially, according to MMT. And then another inflationary factor is investment spending, because investment spending means that basically any spending that's on machinery, on computers, on non-consumer goods, that means that the money goes to people who are employed in a sector that, once again, doesn't produce consumer goods, but ends up purchasing consumer goods from the consumer market. So that can push up consumer prices as well. At the same time, of course, they improve worker productivity. So there's hopefully sort of an anti-inflationary effect, but also a lot of these projects fail. So on the net, this could have an inflationary effect on the economy as well. You were
I mean, to invest in capital machinery, and I've always been trying to bring this big giant Death Star or Starship of business to business transactions to the view of the average consumer. Because, you go to the mall and you buy stuff and you have there's a store and there's a product and I've got my Visa, whatever. That's like a tip of the iceberg of what actually goes on in the economy, the business to business sector, which is what I worked in for many years as a software entrepreneur. I was a business to business guy. I sold to big corporations. I never sold to the end consumer. And, to me, investing in improvements in capital machinery, upgrades, and so on, you only do that because you're hoping to produce goods that are going to be bought by somebody, probably the end consumer, and so on. And like when McDonald's puts their touch screens in because the minimum wage went up too much. Okay, well, they're doing that for the end consumer to keep prices low for the end consumer. It's really a consumer focused kind of investment. And yeah, some of them fail, but if we're going to say, well, capital allocations fail, that's kind of an argument against MMT, because if individuals spending their own money in their own corporations, or at least their corporate money, if they have a significant chance of failure to the point where it might drive inflation, then people in charge of other people's money through MMT are going to have a much greater chance of failure. So I think in general, those things tend to improve productivity. There's a huge amount of research done, test case scenarios, spreadsheets with n-dimensional learning curves and so on. They'll roll it out to a small number to check. They really do, the amount of cost-benefit analysis that I had to produce in order to sell $1 million worth of software to a Fortune 500 company was enormous. They really are pretty careful with that money. So, yeah, it certainly could happen, and there are failures for sure, but in general, the money is spent pretty well. And where the failures occur, it's often because Bernie Madoff turned out to be running a Ponzi scheme or something like that, which is a bit of a white swan event.
Yeah. So I think you're right. The inflationary effect of the investment spending is probably minimal, but I just wanted to sort of lay out the MMT theory of inflation, and it's basically the three things that I just mentioned. If the sum of deficit spending plus export surpluses plus investment spending grows as a percentage of GDP, that can have an inflationary effect on the economy. That's the one big theory of inflation that MMT has. The other one is just if you have a commodity price if you have a monopolist, for example, OPEC, that can set the prices of a commodity and they just raise it to some arbitrary level, and the entire economy is affected by that because now all prices for industry, machinery, car fueling, etc., go up, then that will have an effect on consumer prices. And that's what we saw in the 70s, actually. According to MMT, going off the gold standard wasn't really the trigger for the elevated levels of inflation that followed, but rather the oil price shock and the ensuing shortage in oil, the increase in the oil price. And in fact, I believe the central bank tried to raise rates all the way through this. The rates ended up at 20% or so at one point. Inflation didn't stop. What did stop the inflation was the government deregulated the price of natural gas, because now there was a competitive element in this whole thing, and the oil industry was constrained by whatever gas was available, etc. That's actually Warren Mosler, the creator of MMT's view on what happened in the 70s and the 80s. And another big thing, because we talked about Japan, deflation, etc. before, MMT suggests that raising interest rate actually is inflationary, not deflationary. Because when you raise interest rate, the net money that's injected into the private sector goes up. Because the money that borrowers pay on their loans is a wash when compared to the interest that savers earn on their savings accounts. But what adds the net money into the economy is the treasury securities and treasury bonds that pay interest. So if the interest rate goes up, there's a net increase in the money injection into the private sector. Like I call it a universal basic income for the rich, because that's really what interest rates are.
Oh, so, sorry, finish your point. I have something to ask about bonds, but go ahead.
But if interest rates go below zero, or if they go lower or even below zero, that's actually deflationary. So now we can understand why have we seen deflation in Japan all these years, because they have negative interest rates and they think lowering the rates to even more negative is going to
cause inflation.
Reverse it.
Yeah.
So all they're doing is creating more deflation. And sorry, that was just what I wanted to say regarding
Japan, of course, I forgot to mention this earlier, but it's pretty obvious. We can just touch on it. I'm sure we all agree that one of the reasons Japan is experiencing deflation is because it doesn't have mass immigration, which of course drives up demands with people's needs. So according to MMT, we talk about government bonds, right? So government bonds are a big thorn in the side of people who accept the Austrian school, because they say, look, the government is pretending to add value in the here and now by borrowing from the next generation at interest, and kicks the can down the road, makes it worse, and so on. But MMT, if I understand it rightly, says, look, there's no need for the government to sell bonds. Why would you need to sell bonds? You could just create the money on your own. Mm-hmm. The government, maybe they'll sell bonds to drain excess reserves, but the existence of bonds, mostly referred to them as savings accounts at the Fed. It's not a requirement for the government to have bonds or sell bonds, but it's a policy choice. And that is a little tough for the Austrians to process.
Because, but we see it now, because so if the government just issued money and didn't sell bonds, there would basically be a perpetual zero interest bond. That's what the money is, really. And then people say, well, nobody would buy that. And at the same time, we now see people are buying even bonds that are 30-year duration and pay a negative interest rate in Japan and in Germany. In the US, we're not there. I say fortunately, because I like to have some money in bonds in my portfolio for various reasons. But that's really... I think that makes it very clear that we don't need to pay. I mean, the government doesn't need to pay interest on bonds. It's a choice, and it's obviously a choice that was probably a choice that was informed by people who have a lot of money and who want to earn free money on their bonds. And those people have a lot of influence in government. And at the same time, there's this whole narrative that the government needs to borrow and needs to pay this interest. That illusion keeps this whole system, this whole setup alive, basically.
And there's another interesting point that you actually found this out. You can see this on the Federal Reserve website. Do you know where 98% of the interest that the Federal Reserve collects goes? To the U.S. Treasury.
Yeah.
Right.
So there's this whole thing like, oh my God, that the Federal Reserve is just extracting all this money from the population because they have the monopoly to create this money, and then we got to borrow it from them, and they charge us interest on this money. Well, all the interest they get, it just goes straight back to the government. And the 2%, this is another thing for the Austrians listening. The 2% that doesn't go to the U.S. Treasury goes to the member banks, and then this is kind of where the mystique of like, oh, the Federal Reserve isn't federal, it's not government, it's privately owned, comes from. Is that if you look at the Federal Reserve Act, it's written in corporate language as opposed to legal language, but I think it's important to understand it's still a legal document because it's a Federal Reserve Act from Congress. That in order to be a bank in the United States by law, which is the Federal Reserve Act, you must own stock in the Federal Reserve, and the Federal Reserve is going to pay you, I think it's 6% or something on the stock that you've purchased in the Federal Reserve. That's what that 2% is of paying back member banks. And it's not like the member banks are the secret cabal of people that actually own the Federal Reserve. It's like literally, in order to be a bank in the US, you have to be a member of the Federal Reserve per law.
Everyone, please like, comment, and subscribe to help us grow this channel. I think we cover a lot of good stuff. We're covering ideas that you're not hearing anywhere else. Economic ideas, historical ideas, systematic politics ideas you're not hearing anywhere else.